Welcome to TradeTheMBI.com. This is John. This report is for the 16th, tax day. Very exciting for everyone. Just depends on how well you've prepared. From the daily standpoint, we've prepared for this modest little, up move here as we've looked at the zones. We're now seeing a dip in our Morganacci here of the 38, which means we're above it, even though we weren't quite above it from before, and that's okay. What we're seeing, though, is sort of a little bit of a breakdown here from the DOC standpoint of midterm buyers as well as short-term buyers, and we need the new zone, really, if you're going to continue this rally. Otherwise, we're just going to kind of fade back into the range between the 38 and 23. Actually, it'll probably be now above the 50 simply because it's falling from a high standpoint. So as that decreases, it will just change the zone slightly. So it kind of not a great oomph or bias to the upside with what we're seeing. I know we're seeing a small increase to start the pre-market, but that can change very easily. 9 points, given that I don't know if you took a look at that ATR down there, 53. So still maintaining an outside normal range, which perhaps we're actually developing a new normal. The NQ doing much better, near the 50%, getting very close to positive shakeout readings, but needless to say, showing the exact same weakness building. Especially as we go into the end of the month, it's relatively important now that we're in the second half, and the euro caught in this range, new accelerated one, which is a full, 8 to 10 cents higher than the real range was before, which is around 13 to 16. So that certainly is helping keep the S&P where it's going. Still elevated from a treasury standpoint. This should still be heading lower, but there's still a lot of uncertainty. And this is going to really make a difference now as we pop into even greater highs with summer building. This is going to add to the inflation story, and that is certainly going to be a factor for the Fed and how aggressive they are with rate increases. And gold, pushing right back up. Some people look at these things and they thought, oh, the end of the world here, death cross. Yeah, okay. But we have rising gold and cyan under red, which is always long. Always a long. Here we go from an intraday standpoint. It was quite an interesting day. We had a lot of good mobility to the upside, some decent short aspects. What you're looking at here is just some of the buy signals that came through, then turns. Instead of going with the earlier move because we had the rising gold, it's waiting for the negative shakeout at this particular point, which happened to be at the 76% Fibonacci line right there, and caved all the way down until we got back up to the positive level, and then we ended up with another mid-level short coming right through there, turned back positive, and that was going all the way into the end of the day, and that would remain so as long as that shakeout remains positive. I know we're seeing a modest DOC spread right there, but again, rising gold, which did its job, got us to new highs. Well, all we needed to do was touch the highs. It actually gapped up, and we're fading back from that huge gap up, filling in probably some of that space, but moved us all the way right back up to where the previous highs were, almost just a little shy of it, and right in line with pretty much how the market's been going with as the rhetoric of war and everything else fades. You move back into a general bias, which has been to the upside because we have a growing economy, and it's pretty much the nuts and bolts of it. As soon as you don't realize that the economy is growing, then things change. But until that time, you just have to go with what it is. This is part of a program I've been working on to make adjustments to eliminate some of the softer buys that we see in downtrend and uptrends, and it'll be very effective once it's complete. You're not going to see the visual effect of it just yet, but what will happen is you won't see a lot of the GAMs or MBIs in a declining market mode, and so that'll have a huge impact on how you see things. And the idea being getting a an effective range that doesn't necessarily capture the tops and bottoms, because certainly we can do that with the DOC spreads and everything else, but it isn't always the most effective from a trading standpoint. We want to have the broadest, most viable moves, and as you can see, some of these become much cleaner to use. I mean, this was 14 on the decline, only 3.5 on the upside, but then 12 going down. Now this one, well, it's much more than the 9 points. If we moved all the way up to where price currently is, we'd be plus 12 already from where that original signal. And of course, you certainly could have gotten in earlier. This is the interesting thing about these. Some of these early signals that come in below the 23%, you can still get a couple of zones. So this is one of those difficulties of managing between those that like to take smaller mid-range scalps versus looking for a bigger trend within early signals from a 5K moving on up. Just different approaches, and I think that having the ability for everyone to pick which they're most comfortable with certainly is something I've always been for, because time frames for everyone are different, and really the only trading vehicle, as far as I've ever determined, was depicting your time, because really that's the only thing that changes value-wise. So for me, the closer to actual trade in time, that's why I've chosen the 5K tick as sort of that early point. Much tighter than that, you get into really choppy scalping for just a couple. But this 5K range, we can collect very, very broad runs while still staying tight enough to where, like on a 50K, you don't have an enormous bar of 40, 50 points before it closes. So some of these things affect the way certain programs run. So always trying to find a happy median in between, and sometimes it takes a little bit of an experiment. But in this particular case, once it's all lined out, I'm hoping it'll be done in the next few days, and I'll be able to give you a presentation of what it looks like. You'll start to see a lot more singularity in coloring, so that'll be a good thing. As always, though, trade well. I'll keep putting up the charts on the Skype chat, and you continue to answer any questions that you might have, and if anything relevant pops up, we will certainly address it. You can see that we had positive extremes from the breakout move, and all those have been filled right through there. We don't have anything real special. The last dip below the red line was filled right here from the extreme histogram standpoint. So we're pretty clean from that telltale drama, so we'll just be looking for like this, where we have extreme algo activity in the form of DOC orange popping above, or even in this particular case, the steel popping above, and then making a dramatic move all the way down to get completely reset here after the little bit of a dip. So that's an opportunity for new buyers who, all set and ready to jump back into it. So, again, good volatility, and we'll keep taking advantage of that. It's not something to be afraid of. It's certainly something I think is worth embracing. As always, though, trade well. We'll talk to you later.